welcome to the Business Standard Morning Show. I'm Meenu Sandhu. Let's take a look at the stories for the day. Geopolitical tension in Eastern Europe has led to a substantial jump in the price of crude oil, which has soared past $90 per barrel. Some analysts fear it may even touch the $100 mark in the next few days, since oil demand has risen the world over due to a waning pandemic and a rebound in economic activity. This has come at a time when retail inflation is at a 7-month high. So what does this mean for the economy in India, which is the world's third biggest oil importer? This report offers some insights.
The economic survey tabled recently has projected a real GDP growth of 8 to 8.5% in FY23, assuming that oil prices will average $70 to $75 per barrel in the next financial year. But that doesn't seem to be happening. The price of Brent crude oil crossed $96 per barrel on Monday amid fears of a possible Russian invasion of Ukraine, with the US saying such an invasion could be imminent. However, it dropped to $94 a barrel on Tuesday after Russia's announcement that it is withdrawing some of its troops from the border with Ukraine in a possible de-escalation of tensions between the two countries. Amid all this, India's retail inflation rate accelerated to 6.01% in January, breaching the upper tolerance limit of the Reserve Bank of India after a gap of 7 months. And for the 10th month in a row, the wholesale inflation is in double digits, coming in at 12.96% for January. The rural belt was worst hit as the pace of price rise touched 6.12% from 5.36% in December, while in urban areas it was 5.91% in January, marginally up from 5.9% a month earlier. According to experts, higher edible oils component pushed food inflation, while clothing and footwear inflation also soared to 8.84%, up from 8.3% in December. Economists have warned that rising oil and food prices pose a risk to inflation. But RBI Governor Shaktikanta Das said the central bank's retail inflation outlook for FY23 was quite robust. The RBI has projected average retail inflation of 4.5% in FY23. Das reiterated that inflation momentum was on a downward slope and the central bank had taken into account all scenarios. India is vulnerable to fluctuation in oil prices as it depends on imports for more than 80% of its oil needs. Market watchers expect oil marketing companies to effect a sharp hike in petrol and diesel prices in March once state assembly elections come to an end. Fuel prices have remained unchanged for more than 3 months now, despite a sharp uptick in crude prices. An RBI paper from January 2019 said that if a crude price shock hits the Indian economy, the current account deficit to GDP ratio will rise sharply irrespective of a higher GDP growth. And a $10 per barrel increase in oil price will raise inflation by roughly 49 basis points or increase the fiscal deficit by 43 basis points as a percentage of GDP if the government decides to absorb the entire oil price shock rather than passing it to the end users. Economist Madan Sabnavis explains the impact of soaring oil prices on government finances.
So the crude oil price is now moving towards the $100 mark, and I think there are expectations that it could also go towards the $120 per barrel mark. The budget has not made any provision for the prices going up, which means that in case there is the likelihood of the price going up, say above $100 per barrel, the price of petrol and diesel goes say to 120 or 130 rupees per litre post the elections. Will the government really be in a position to lower the excise duty any further? To my mind, such a provision has not been made in the budget. So it does look like that the government is counting on the crude oil price remaining fairly stable. And there's no provision made in terms for cutting the excise duty. The second part is that in terms of the RBI's policy, see, the RBI has taken a rather benign view on inflation, saying that inflation is going to come downwards and probably go below 5%. And therefore, they have retained their initial target of saying that we need to control the growth process. When they say control the growth process, try and make sure that the GDP growth remains resilient and is what they call durable. So the question is that will the RBI still be in a position to ignore inflation in case it shoots up on account of crude oil price going up and the government's inability to lower the excise duty in order to counter this increase? I think that will be the major thing to look out for during the course of the year, especially in the next few months, where it looks likely that this number of 100 will be breached, and we could actually be looking at a number of $120 per barrel. So in short, I think what this really means for us is that we may have to live with higher inflation. The current account deficit will also come under pressure. We will also see the government having to take certain hard decisions in terms of the excise duty rate. And if the central government doesn't do it, I think the onus will fall on the states to lower the VAT in order to make sure that the consumer is insulated from it. Otherwise, both the WPI as well as the CPI will continue to move in the upward direction. And say a $10 or a 10% increase in the crude oil price can actually push up the overall WPI by at least 1 to 1.5%, given the direct and indirect implications. And if you look at the CPI, we could think of something like 0.4 to 0.5% increase in the CPI on account of a 10% increase in the price of crude oil.
The government is hoping that crude oil prices will come down over the next few months, so it won't be forced to cut excise duties to rein in inflation when oil companies pass on higher costs to customers. Given the budget has not made any provision for a cut in excise duties, in case crude oil prices remain persistently high, both the RBI and the government will find themselves in a tricky situation.
From the rising crude oil price and its impact on the economy, let's turn our focus to the healthcare industry. In an interview with Business Standard's Shohini Das, Chairman and MD of Aster DM Healthcare, Azad Moopen, talks about his expansion plan in India. The company, which is one of the largest healthcare providers in the Gulf, recently signed an agreement to open its 6th hospital in Kerala and the 14th in India. Let's listen in.
Coming to your India plans, there are, I think, plans to add a lot of new hospitals, and most of them are likely to be brownfield. So if you could explain your India expansion strategy, also why brownfield?
It's not that we are just focusing on brownfield, but we'll also have greenfields. But this is a strategy which we thought that can definitely reduce the overall investment. So along with the greenfield projects which we have, we want to add maybe a percentage of that as brownfield. So as you know, the brownfield strategy is where you already have an existing hospital, where you go into an O&M agreement, mostly, or a lease agreement, where you are taking the premises and sprucing up the facility and adding equipments. So that may cost you maybe 15-20 lakhs of rupees per bed. Whereas if you are going for a new hospital bed, depending on the land price, it can vary from 80 lakhs to 1 crore. So that huge difference is there, and definitely you'll have to pay a lease rental or a percentage of the top line. But looking at everything, as we want to reduce the investment, further investment, and reduce capex, we thought that this will be a good strategy, especially in areas where we already have a good presence.
So you are also open to the O&M model, right? I mean, where someone owns the real estate and has a hospital in place. So
Very
for that, which are the cities or what categories of cities would you be targeting?
Right. So we would like to look at hospitals for such activities around the place where we have already existing hospitals. For example, Bangalore, we have 3 hospitals there already. So it will be very convenient to have hospitals in cities around Bangalore. Like that, in Kerala, we have in 4 cities, we have already existing hospitals in Kochi, Calicut, Kannur, Kottakkal. So we want to have this around our existing hospitals. The reason why we are doing that is there is a lot of synergy regarding the availability of doctors as well as some of the investigations and all.
With your model of having a mother hospital and feeder hospitals, how are you thinking about scaling telemedicine or taking it to the hinterland more?
We are, in the process of pushing virtual care and telemedicine to a great extent in all the geographies we operate. So we have a separate vertical which has been created for that. And what we are doing is that it's not only the consultation which we want to provide. See, when a patient, what is the patient's journey? He has a problem and he wants to consult a doctor and get maybe tested, as well as then get the medicines being delivered. This usually was happening in the physical mode. And this is where the patient comes to a clinic or a hospital, gets a consultation, go and do some testing, then goes to the pharmacy with the prescription of the doctor, and then comes back home, which is half a day most of the time, or sometimes even a full day. This is something which we want to reduce it to few hours, where this patient has a consultation with a doctor on our platform. And then the patient, if at all he requires an investigation, we have the Aster labs which are being spread out, who will provide that home care, and they will collect the phlebotomy and collect the blood or whatever is required. And then the doctor sees the result and prescribes the medicine, and the medicine is delivered to the houses of the people. Our pharmacy, which is now, we have over 100 pharmacies in India already. So from there, we'll be delivering the medicines to the patients' houses. So this whole process, sitting at home within 1 or 2 hours, he can complete it, which is what the way in which world is moving.
You mentioned pharmacies. What your outlook for the organized pharmacy sector in India? Secondly, would you also be open to inorganic expansion in this space?
Pharmacy, as I said, that this is part of our overall strategy. If you look at our GCC, we have clinics, pharmacies, and hospitals. That's an ecosystem which has worked very well for us. So we want to create in India also. So for us, it's part of an ecosystem. It is not just having pharmacies for the sake of having pharmacies. But along with that, we want to take the opportunity to a next level, where we can even go to places where we don't have hospitals. So our plan is to have this year 150 pharmacies being rolled out. We already have crossed 100. And by next year, we'll have another 150. And in 3-year period, we would like to have 500 pharmacies. And the aim is by 2025 to have 650 pharmacies. Responding to your question regarding or inorganic growth, we are open for that. We are wanting to do that, not only for the pharmacies, even for the labs. We are looking at suitable opportunities of acquisitions in the areas where we have our strategic plan.
You already mentioned that India is going to be 40 to 50% of the group's turnover in a few years. Could you elaborate on that a bit? And why the focus on India? Because you're already profitable in the GCC. So what is your expectation from the Indian market? What are the opportunities and challenges that you see?
We have been very successful in the GCC, especially in UAE, which is our main market. We have a very profitable business, both in the hospitals as well as clinics and pharmacies. But when you talk about 10 million population, which is UAE, and when you look at India, which is 1.3 billion population, and UAE or GCC being a market where there is already some amount of saturation, and there is sufficient demand supply. When you look at India, the demand supply gap is huge. So we see that in the next 10, 15, 20 years, India is the opportunity. If you look at our this year YTD EBITDA, already we have reached about 27% of the YTD EBITDA from India. We want to gradually bring it up to 30, 35, 40% as we go forward.
Shares of Aster DM Healthcare touched a new high last week after it reported an annualized 61% increase in consolidated net income. Meanwhile, the Indian rupee rose for the first time in 6 days yesterday, as reports suggested the withdrawal of some Russian troops from the Ukrainian border. While this may have comforted the domestic currency, economists fear India's delayed policy normalization, rising inflation, and ballooning trade deficit account may support dollar bulls over the next 3 months. Watch this report for more.
Reports of Russian military returning to their base camps stabilized forex markets yesterday, allowing the Indian rupee to rise for the first time in 6 days. The Indian currency settled at 75.33 per US dollar mark on Tuesday, but continued to hover around 6-week low levels. It touched 75.64 per dollar mark on Monday, its lowest level in 2022. According to media reports, Russian Defense Ministry has said that military units from the southern and western districts of Russia have begun returning to their garrisons, a move that could de-escalate the febrile standoff between Russia and the West over Ukraine. The developments comforted investors who lost trillions of rupees in wealth due to Monday's market rout. The S&P BSE Sensex titled 1736 points higher at 58,142, while the Nifty 50 ended above 17,350 mark. In the commodities market, Brent crude futures slumped 2.4% to trade around $94 per barrel mark. This sharp drop in crude oil futures eased the demand for greenback in currency markets, alleviating pressures on the rupee too. But the rupee-dollar trajectory will likely remain volatile in the near term till there is a definitive agreement between Ukraine and Russia. Besides, multi-year high inflation across global economies, along with a dovish RBI policy, is expected to keep dollar demand pumped up in the markets. According to Julius Baer economist Sophie Altamart, we expect the USD INR to rise around 76 in the next 3 months as India's monetary policy normalization is delayed in a global context and high commodity prices are weighing on India's trade balance and will widen the current account deficit further. Moreover, the prospects for Indian government bonds to be included in global bond indices in 2022, which would provide indirect support for the rupee over the medium to longer term, have diminished. Vivek Kumar, who is economist at Quantico Research, too believes the rupee may reach 76 to 77 per dollar over the next 3 months as a sharp rate hike cycle in the US will support dollar bulls. Trade normalization post-pandemic, increased pace of vaccination, volatility in crude oil prices, and uneven foreign fund flow could also put pressure on imports. This, he says, will widen the trade deficit account in fiscal year 2022-23. Though over the next fiscal year, he expects the rupee to stabilize and see lesser volatile moves in FY23.
In FY22, the estimate is that the BOP surplus could be somewhere close to $43 billion after you adjust the special SDR transfer which the IMF did. For FY23, our estimates suggest that the BOP surplus could fall down to single digits. Now that's a big evaporation of support to rupee, and this is likely to come about at a time when the dollar sentiment is extremely positive. So the depreciation bias could continue in the near term at least. However, at the same time, we would not expect a runaway depreciation pressure on rupee. In fact, the volatility could remain subdued. Reason being, the insurance cover which the FX reserves provide is extremely comfortable right now. Vis-a-vis the previous taper tantrum episode in 2013, our FX reserves provide you a cover of 14 months of merchandise import. That is after including the forward reserves as well. Now, this would be almost double of what we were in the year 2013. The other aspect to look at is that growth inflation balance sequentially is getting better after the setback in 2020. For the year FY23, the consensus estimate would be somewhere close to 8% on GDP and 5% on CPI inflation. Now, most of the other countries in the world on the growth metric would be below India. So India probably would be one of the most fastest growing economies in the world. And as far as inflation is concerned, the deviation from the target is something which is pretty moderate. This again is in stark contrast to what we are seeing in most other countries where the deviation from target is sizable. So the macroeconomic balance is better, the reserve cover is sufficient enough to provide or to guard against any unwanted volatility, and that will help in curtailing any bit of runaway pressure on rupee.
Overall, geopolitical developments, crude oil prices, and reversal in low interest rate regime will guide the currency markets over the next few months, as the actual impact of these events is yet to be fully priced in by the markets. As regards today, market participants will monitor developments along the Ukrainian border and their impact on commodity prices. Back home, stock-specific news flow and listing of Vedant fashions will be tracked by the markets.
Lightning-fast internet speed and a well-connected network of computers have been ensuring a smooth run of markets for long. All these computers are connected with a centralized server. But there's another set of network which does not have a server. It's a set of computers talking to each other with no server and no connection outside the grid. It's called a peer-to-peer network, commonly known as P2P. Our next report offers a peek into it.
It may come as a surprise to many that the internet was built as a decentralized network of computers and devices for free dissemination of information. Over the time, the web was taken over by the big tech companies. They not just dictate the type of content allowed on the web, but also control a major chunk of web traffic now. However, there are some networking protocols that enable decentralized system for transfer of information. One among them is peer-to-peer networking, commonly called a P2P network. Peer-to-peer is a network of distributed architecture, meaning there is no central server or client but multiple devices and computers forming a network to share and exchange information. Therefore, each device in a P2P network is equal to the others with no additional privileges, and there is no primary device in the network. In this networking type, the connected devices are called peers, and each peer is both a client and a server. Therefore, each device on the network can download and upload the data simultaneously and does not require a central unit to enable data transfer, because every resource available in a P2P network is shared among connected devices. The P2P network has its advantages and disadvantages. Before we get to them, let's first understand how the resource transfer is done on P2P network. In a P2P network, both download and upload of information are performed differently than how it is done in a centralized structure. In a centralized setup, data, resources, or any other asset are uploaded on a server, which is a central hub for other connected devices to download the information. In the P2P network, there is no central server, but all connected devices act as both server and client. Therefore, when you download the file using a peer-to-peer network, it comes in parts from other peers connected to the same network that have the same file or a part of it. Simultaneously, the downloaded parts of the same file are seeded through your computer to other peers in the download queue. This type of networking is not reliable for storing data. The lack of a central server makes the data vulnerable to extinction. Besides, this type of networking is prone to cyber attacks because it is difficult to secure the complete network, as each device is independent. But this networking type has its advantages too, most of which stem from the decentralized structure. The P2P network uses resources more efficiently than a conventional network, and it is less susceptible to systemic failure. Closing down a P2P network is difficult because there is no central server here. The P2P networks are highly scalable and does not require the kind of investment one needs for setting up dedicated servers to disseminate information. This type of network is most suited for file sharing, especially large files.
Did you know that blockchain is also a peer-to-peer network where peers can do transactions without the need for a centralized authority. That's all for today. For more news and analysis, log into our website www.business-standard.com. We too will be back tomorrow morning with more. Thank you for watching and have a good day.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.